All right, we are recording. So welcome again. Thanks for joining us today. Kathleen, we have a short poll, everybody, that we'd like you to answer. Just a few questions. It'll help inform us on how we want to manage today's session. Kathleen's going to launch that now. If you could just take a minute to answer that. And while you're doing that, I'm just going to tell you briefly about our Lunch and Learn series. It's about business fundamentals. The goal of these quick hit webinars is going to be bite-sized webinars to give you some good information without overloading you with a 3-hour seminar, to give you some good tips for running your business and managing your business. The first module is a 4-part series on knowing your numbers, all financially driven. We did understanding your financial statements on Monday. Today's topic is understanding your cash flow. And then you've got, we have a session on Monday and Wednesday of next week. You can see the topics there. We're going to do budgeting tips for cash flow and one on risk management. We're going to be doing future modules. You can see some of the topics we'll cover on operations, sales, marketing, and tools for success. So we'll do those. Highly recommend you attend all of the sessions. We think that'll be helpful. You get the most out of it. Plus, there's some connectivity throughout. But if you did miss Mondays or you can't attend next week's for some reason, register for next week's. You can do that through our website. We'll show you how to do that at the end. And if you missed Mondays and want to catch it up, or you registered and didn't see the webinar live, you can find the recording for it. If you registered, you would have gotten a link for it yesterday. If you didn't register for it but still want to see it, you can go to our YouTube channel. Just punch in SCORE Greater Hartford in YouTube, and you will find all of our webinars there. So we'll more on that at the end, but don't worry, you're not lost if you missed the first session. Kathleen, anything that came out of the poll that we should talk about before we jump in?
Yes, 47% of the people have been in business less than 3 years, 37% 3 to 7 years, very few more than 7. As you would expect, no one who's attending thinks they're an expert because otherwise they wouldn't have come. 58% say beginner and 42% say intermediate. And 74% of the people on this call right now attended session 1. So a large majority heard what we said in session 1. Okay, great. That's great to know. All right, awesome. Thank you for answering those questions. All right, so let's jump right in. So I'm gonna do a brief recap since a lot of you are here, just quickly, just to refresh a few of the topics we covered on Monday. Then we're going to jump into the big difference between the cash flow statement and the income statement. And then we're going to go deeper on the cash flow statement and just better understand the different components and how they connect to your real business scenarios. And then we're going to go through some examples and some helpful tips. We are going to have time for questions at the end of this. We've muted everybody's microphones right now, but if you have a question as we're going along, you can put it in the Q&A box. We will also have plenty of time at the end for questions to cover them as we go along. So we want to hear from you as we're going through things, either questions or best practices as you think about managing your business. So and just as a reminder, sorry to interrupt, but just as a reminder, when we get to the end Q&A, we stop the recording so that if you have specific questions you want to ask about your business, it won't be on YouTube later. So feel free to be a little more comfortable about sharing some information that you might not otherwise do. Great point. Thanks for reminding me, Kathleen. All right. So just to quickly remind you of what we covered Monday, we talked about the importance of managing your financials, not just to do your tax filings, but also to understand what's going on with your business and the market for the industry you're in. Each of the 3 financials answers key questions. The balance sheet and the income statement are really around your financial health and profitability. And then we talked about the 3 financial statements. Income statement measuring profitability over that period of time. Remember, it's for a month or a quarter or the full year. The balance sheet gives you that financial health snapshot as of a point in time, as of March 31st, 2023, gives you that picture as of that date. Cash flow measures cash moving in and out of the business. Very similar to an income statement, but there are differences, which we're going to get to. Much like the income statement, a cash flow statement measures activity over that period of time. So when you're looking at cash flow, it's what's the cash flow for the month of January, for the 3 months ended March 31st. So the income statement and cash flow are both on that similar over a period of time concept, where the balance sheet is that as of a point in time. It's just important to distinguish those 2 things. So how are the cash flow statement and income statement different? Well, I would say there's 2 main differences. The first is what we call cash accounting versus accrual accounting, which we're going to cover here. The second are items that move through the cash flow statement, but don't hit your income statement. So if you remember the other day, we talked about things like paying debt or putting money into a business or taking money out of a business. And if you recall, those didn't impact your income statement, but they obviously impact your cash. So you're going to see those items on the cash flow statement in a minute. The other big difference is what's called cash accounting versus accrual accounting. Now, if you run your business financials and your accounting books on a cash basis, this probably won't be applicable to you, but a lot of businesses use accrual-based accounting. And what that means is for income statement purposes, you measure your profitability in accordance with the accounting rules. So what does that mean? It means revenue is recognized when the service is performed or when you ship your goods, not when you get paid in cash. The cash flow statement measures when you actually receive cash. So here's an example. Let's say you run a manufacturing or retail organization and you ship a product to a customer, in this example, on January 15th, and the customer pays you on April 15th. Let's say you allow them to pay within 90 days. For income statement purposes, if you were using accrual basis accounting, that revenue would be recorded in January because that's when you performed the service. As of January 15th, you no longer own that inventory. You no longer own that asset. You've traded that inventory for a different kind of asset called accounts receivable. If you remember, we talked about that on Monday. So that's revenue on an accrual basis. That accounts receivable is an accrued amount on your balance sheet that will eventually turn into cash. If you get the cash in April, that becomes a cash event for your cash flow statement in the month of April, not January. So I have this bullet down here at the bottom that says both are important, but they tell you very different information. The revenue on the income statement tells you, when am I earning my revenue? When am I generating that profitability? The cash in April tells you, when am I actually collecting cash? Because if you never collect that cash from the customer, it's, the revenue is kind of worthless because you don't have the money in your bank account. So if you're using accrual basis accounting, it's important to understand the distinction between those two situations. So this concept of accrual basis or kind of receivables and payables creates this concept of what's called the cash gap. Now, I lifted this from another SCORE webinar. I forgot which one it was. I saw it, grabbed it a while ago and said, this is going to be a perfect one for a cash flow webinar. Let me explain to you how this works because it looks rather busy. So if you go from left to right on here, the example here being, let's say you receive your inventory stock on day 0 and you have 30 days to pay your vendor. So for the first 30 days, you've got a payable on your books and you haven't distributed any cash yet. But on day 30, you have to pay your vendor. That's what their requirement is. Now, you're holding your inventory. You haven't sold anything for, let's say, 60 days. And that's this stock holding bar. But then on day 60, you actually ship something to a customer. You send it out to them on day 60. But you give your customer 60 days to pay you. So that's what this green bar is the 60-day receivable. So when you think about what this happens from a cash standpoint, you pay your vendor on day 30. You sell it 30 days later to a customer. They pay you 60 days later. You've got a 90-day gap, which is this cash gap here, from when the cash is received to when you actually had to pay your vendor for that inventory. Now, you're going to, in theory, make more money because you're going to be selling it for more than what you bought it for, which is a great thing. However, you still have this cash gap in terms of when you actually had to pay the vendor versus when you collect money from a customer. So as you think about managing your cash flow and managing your business profitability and your liquidity, which is going to be an important topic we're going to cover at Monday's budgeting session, it's really important to understand your payment terms and receivable terms with your vendors and customers. So if you have any questions on this, want me to come back to it, throw it in the Q&A box. I know this looks a little confusing, but it's just a concept of you could have some disconnect between when money's going out the door to vendors and coming in the door from customers. So as we look at the cash flow statement, there's key financial concepts we want to cover, and we're going to get into an example of what one looks like in a couple minutes. So it's very simple. This is not, it's very intuitive. It's not complicated. Cash flow is basically money coming in and out of the business over a period of time, a month, a quarter, or a year. And it's not rocket science. It's positive when receipts exceed disbursements
It's negative when it's the opposite. When the money going out exceeds cash coming in, cash flow is negative. Pretty obvious. It's like your personal bank account. Now, when you're looking at your cash flow statement, there's 3 categories of cash flow. We're going to go deeper on these in a couple minutes. There's operating, investing, and financing. If you look at any standard cash flow report, you're going to see these 3 categories, from small businesses using QuickBooks up to large public companies filing with the SEC. Everybody's got an operating, an investing, and a financing. So what do all these things mean? Operating cash flows are what I call ongoing business activities. And here are some examples. Cash inflows are things like service revenues, revenue from sales of products, any money you're bringing in. These are examples. Money coming in for your ongoing business activities. It's not money coming in from a bank because you took out a loan. That's a different category. Think about this as ongoing business, your basic day-to-day things. Outflows, cost of goods sold, your operating expenses, payroll costs, utilities, rent, any of your overhead costs like insurance, legal, or accounting fees. So when you think about these things here, this looks very similar to what's on an income statement, right? And that's why an operating cash flow and an income statement kind of close to each other, except for that big disconnect on cash and accrual accounting. So operating cash flows and income statement, very similar, apples to maybe different kinds of apples, but both apples, if I could use a strained analogy there. One concept that we talked about with the income statement the other day is in looking at your operating expenses between fixed and variable. Also very important as you look at your cash flow. So as we think about the things here, your costs of goods sold are going to be a variable cash flow, whereas something like your insurance costs might be fixed. So important to manage that aspect of your cash flow as well. The other 2 categories are financing and investing. Financing is primarily from 2 sources, either borrowing from a bank or investing from an investor, getting money in from an investor. So if you think about interactions with a bank, if you borrow money from a bank, it's inflow into your business bank account. When you make payments on that loan, it's an outflow. Same thing with investing your own money, or you have other investors who invest. If you contribute money to the business, that's an inflow. If you have an owner's draw, that's an outflow. And you see, if you think about this as the financing description, it's really in the word. You're financing the operations of your business. How are you financing that? Either through debt from a bank or equity through investors. That's the way to think about financing cash flow. So what are investing cash flows? Now, you might think of investing as getting investors to invest in your business. That's not what investing means. Investing cash flows show up in financing. Investing cash flows are where you take money from the business and invest it back into the business with a new capability. It could be new equipment. It could be new software. It could be new machinery. It could be you could buy another company. If a company goes out and does an M&A transaction and acquires another business, that's an investing activity. You're investing in the future capability of your business. Most times on a cash flow statement, investing activities in the cash flows section are going to be outflows because you're generally acquiring things. But you could have, if you have investments in the stock market and you sell those investments, that could be a proceed from an investing activity. But most times for business owners, it's going to be an outflow. Key question to consider when you're thinking about investing is, can you afford it and will it generate profit? Now, that's a separate business decision, right? As you think about the trade-offs of whether or not you want to invest in your business. And the question to ask yourself is it going to help me generate more revenue, lower expenses, or both? Or give me a capability that will do those things? The key concept as you're going through and tracking your financials in your accounting software is to track these activities separately. That'll become more obvious when we start doing some of the budgeting activity next week. But it's important to look at these things differently because they are truly unique business transactions. So here's an example cash flow statement. This is just one I found online. And this is typically how they're organized. So I'm going to walk you through. This is a sample for a retail company. So you can see it's a guitar shop. So generally what you're going to see are 3 main categories: the operating section, the investing section,
and the financing section. Then there's a total at the bottom that basically says, what's the total of all three? And then the reconciliation says, what was my beginning balance? And now what's my ending balance? So what this shows at the top in the operating section is, you can see the categories here. It's money that's coming from customers. You can see Paul's guitar shop. He had to buy some merchandise. He had to pay his employees. He had to pay his interest and taxes. These are all things you typically see in a P&L. So pretty similar, as we talked about the operating activities and the income statement being similar to each other. And you can see over here, I have a comment here that says the operating cash flow answers the question of how much is the business generating to reinvest or distribute to the owners? Because that's what you do with your operating cash flow. You say, what do I want to do? Do I want to reinvest it back in my business? Do I want to pay myself? Or, those are kind of the two big decision points. So then you've got investing cash flow. And here you can see he had to purchase some property and equipment. So he probably bought a building for his guitar shop. And he probably had to make some investments in that building for some equipment and some shelving and some, all sorts of, racks and everything for the guitars. And so that's how much he spent for that. The financing activity basically says the two categories I mentioned earlier, which was how much am I getting from the bank to help finance it, or how much am I paying myself back, or am I putting into the business? Now, in this example, Paul has done everything through financing, because what he's done here is he's taken out $10,000 from a line of credit. He's also received $99,500 from a long-term loan. So what this tells me is I step back and say, okay, what did Paul do as I look at the year ended 2015? He generated $24,000 in operating cash flow, which is great. He invested $101,000. God, where did he get that money from? He borrowed $110,000 in financing from the debt to help finance that, to help finance his purchase of equipment. And when you add up the three categories, if I take the 109 minus the 101 plus the 24, that should add up to the 32,800, which is his net increase in cash. And then when you add, he started with zero, so his ending cash is the same. So the net cash flow, when you're looking at this, you want to step back and ask yourself, what's happening in the aggregate, which is the 32,800, and then what's happening in each of the three categories, and then ask yourself, what story is it telling me? Is my operating cash flow positive or negative? How much am I investing? And then how am I doing on my financing? Am I paying down my debt? Did I have to put a lot of my own money in? And when you look at the cash flow, it's helpful to see what story it's telling you. And also, I have this bullet down here that says to look at what I call the quality of the cash flow. So what do I mean by that? Well, depending upon where the numbers are, it can tell you a really different story. A lot of times when large companies' financial statements are examined, the income statement can be important, but it can also mask a lot of things. Like if you're earning a lot of revenue, but you're not collecting cash, that's not a good way to run your business. And if you have to take out a lot of debt that's showing up in your balance sheet, and maybe it's not really showing up in your income statement yet, but it's going to show up on your cash flow statement. So a lot of times you'll hear people say that, kind of the introductory investors will look at an income statement because that's the P&L, and they hear, well, the income statement shows profitability. But the really astute investors will look at a cash flow statement and say, how is this company managing their cash, and are they efficient? So let me give you some examples of what that might look like. So I'm going to share with you three different businesses here. So here you can see I've outlined the three different categories. Got the operating, the investing, and the financing. Very similar categories to what we just had on the last one. Now, the first business is the scenario that I'm calling the dog ate my profit. And so the scenario says like, hey, wait a minute. I looked at my income statement and I'm making money. Why don't I have any cash in the bank? So what's going on with this business? Well, for starters, their profitability before interest and taxes was $28,000. It's pretty good. And then after they pay their interest and taxes, their net cash flow from operating activities was $24,300. That's pretty good too. So why do they only have $6,000 in the bank? Well, what else is going on in the cash flow statement? They bought $13,000 worth of equipment, and they also had to pay $7,000 to their lender. Now, these two things are not going to typically show up on your income statement.
These are going to be the big things that are going to stick out in your income statement. So if you're looking at your financials and going, God, my P&L in QuickBooks looks great. What's going on with my bank account? Look at your cash flow statement and see what else is going on in the investing and financing activities and see if something might be happening there. So the second scenario is what I call the bank balance mirage. So this is where you say to yourself, okay, well, I've got some money in the bank account. That's okay. You know, I'm doing all right. It's not as much as I would have liked. It's $6,500. I wish it was more, but I'm doing okay. Let's step back and look at something. My operating cash flows are negative $21,500. That means from my ongoing business activities, I am spending a lot of money and I'm not collecting a lot. And you can see this. Now, these are all made up numbers I just made to make the math work, but you can see they bought a lot of inventory. They had a lot of operating expense payments and they didn't have a lot of revenue. Now, maybe this is a business that is just starting out and they got to spend a lot as a startup before they start really ramping up their business. And that may be okay. But they also spent $12,000 in new equipment. And you say to yourself, where did the money come from? Well, here you can see down in the financing activities. They borrowed $33,000. They paid a little bit of it back, and they also put $8,000 of their own money in. So this is basically saying that their net cash didn't change much, and they're still sitting with a positive bank balance. But this is a red flag for any astute investor: negative operating cash flow, high financing cash flow. This would tell you, if you look at this business's balance sheet, you may see a situation where they've got high debt compared to their current assets. Their cash, accounts receivable, inventory might be kind of low. If I were looking at a business and I saw negative cash flow and operating activities, and they've been in business for a while, I'd say, wait a minute, what's going on with this business? And if their P&L was showing okay profitability, I'd say they're not managing their cash very well. Maybe they've got big receivables they need to collect. So this is why I call the bank balance mirage, because if you only look at the total in the bottom, you think, well, it looks okay. You got to peel apart the individual components to see what's going on. So my last scenario is what I call the balanced business, right? This is the, everything's running fine, nothing major to worry about. So in this business, they've got some strong sales. They're managing their inventory and operating expense payments well. They're managing their debt and their taxes. They've got positive cash flow from operating activities, which tells you they're efficiently managing their liquidity and working capital. They did make some investments. They've invested back in their business a little bit where they felt it was prudent. And then in terms of their financing, you can see their net activity between their lender is a $4,000, proceed and a $4,000 payment. Maybe they tapped into their line of credit during the period to manage a liquidity crisis, but they paid it right back because they were being efficient with how they managed their cash. And they paid themselves $12,000. So the cash withdrawal to the owner goes in that financing activity section. And then you can see at the end, their cash flow went up for the period by $15,800. And at the end of the period, they had $25,800. So this just depicts three different scenarios. I stretched the credibility on some of these to highlight a few points as to what could be happening when you've got some things that say, my P&L says look like I'm making money. Why don't I have it in cash yet? And it could be those receivable, payable, cash gap issues we talked about, or it could be you're taking some of your profitability and spending on other things that might not show up in your P&L. You've got the issue of the business that's really leaning on lenders and borrowing a lot to help finance their ongoing business operations, which could be problematic because that's not a path for long-term success. And then you've got the business that says, manage my operations and my cash flow as tight as possible, use those proceeds to reinvest back in the business and pay myself. So that brings us to the next slide. What do you do with your profit? I'm calling it profit / net cash flow. Not exactly the same, but you can guess by everything we've talked about with the income statement and cash flow concepts, why these two things are very similar. First thing to do, pay your taxes, pay your debt. You always pay your taxes. You want to work with your lender. If you're having any cash flow issues, work with your lender to understand if you need to talk to them about extending payment terms, if you need to be upfront with them. If you're having some sales difficulty, we always encourage our clients to establish relationships with your lenders upfront. It's important to meet with them so that they know you, they know your business, they know what makes things tick for your business. It's important to do that in the good times so that if you have to call them in the bad times, they can understand things and know that you know what you're doing. You maybe you're just running into a rough patch. So if you're having any cash flow issues and you've got some debt payments coming up, work with your lender to talk with them about what's going on. But first and foremost, make sure you're paying your taxes. I'm not going to go deep on taxes here, but the recommendation we always provide clients is working with a CPA to help estimate your tax payments. It's important to do that throughout the year. We're going to talk about that a little bit more in the budgeting section next week. But as you're working on your tax estimations, you don't want to wait. If your business is making money and you're making a lot of profit throughout the year, and maybe you've got a second job and you're making money there as well, your tax situation may become complicated depending upon what else you have going on in your life, how you file, if you own real estate or not, if you own your home or not. You really don't want to wait until the following April to file your tax return without having made some estimated tax payments, because the IRS and the state of Connecticut are expect you to have been making estimated tax payments throughout the year. So work with a CPA on that. Once your business reaches critical mass, it's worth the investment of time to have your CPA focused on helping you navigate the tax code so that you can help service your clients. So that's my first piece of advice: pay your taxes, pay your debt. Then you ask yourself, reinvest in your business, pay yourself. These are discretionary decisions. I know it's really easy for me to say, I'm not running my own business. All of you are. And the natural inclination is pay yourself first. However, you got to make sure you take care of these things. I always like to say, always pay yourself last, but I understand a lot of people say, hey, I need to take money out of my business for my personal expenses. Totally get it. That's part of our budgeting process to say, what are the owner's withdrawals I'm going to need to take every month or every quarter to maintain my, personal and business bank balance? And how do we budget around that to ensure that we're managing our revenue and cash expense management in such a way that we can meet those goals? But you also want to think about where you can reinvest in your business. And this can take a whole number of different decisions. I gave the easy example of, let's say you're, running a restaurant. You say, hey, maybe we need some new equipment for the kitchen. It's been a while. These things are a little outdated. Maybe we need to buy some new things. But it could also be staffing. Now hiring more people is really an operating cash flow. It's an operating activity. It's not necessarily an investing activity, but think about it like you are investing in your business by expanding your operations, hiring more people. And that's part of budgeting, is to understand if you can afford to do that with the revenue that you think could come in. So these are the different components of cash flow. And as you're thinking about investing in new capabilities, maybe it's a new vehicle, a new truck. Maybe you've got a landscaping business and your business has been growing so much, you want to, get some new mowers. And, what you can help to do is think through, what's it going to cost me? What period of time am I going to pay for that new mower? And then what do I have to think about in terms of new revenue to help pay for that? How long am I going to, could I pay that mower back with an extra, $5,000 of revenue over the next 12 months? Will that pay it off? And thinking about, that helps you think about the rationalization, or the justification is a better word, for that investment in your business. So they're not always cut and dry answers, but budgeting and helping to understand where your cash flow can come from will really help think about those. So I call these discretionary decisions because the decision of whether or not you do these, yes or no, is really up to you. Whereas these items up here are not. They're determined by your tax obligation and your debt obligations. These are more discretionary to say, do I want to invest? Yes or no? Do I need to pay myself? Yes or no? And then also when and how much, because you can change the timing and amount of these decisions. It's up to your discretion based on how you can afford things. So I think that comes to the end. We went rather quickly through that. It's only 12:30, so we've got plenty of time. Kathleen, do we have any questions yet that have come in?
We do not.
All right. Well, that's good. Maybe I've been thorough as we've been going along here. So if you have questions, feel free to put them in the Q&A box. But while you're thinking of your questions, I'm going to cover a few more bits of information about what's coming soon, and then we'll stop the recording so that we can answer some questions. So you can sign up for future webinar sessions. We've got 2 more in this series that we're doing next week. On Monday, we're going to do budgeting tips for managing your cash flow. This one, think about this one as being kind of the introductory, how do I think about my cash flow in the various categories? Part B of that is going to be on Monday. We're going to dive in deep. We're going to talk about how to budget, what you need to think about, the information you need to gather. I'm going to give you all the budgeting tips that I can think of. I'm going to give you an Excel tool that you can use, a spreadsheet that I share with my clients that I think you'll find helpful. And then on Wednesday's session, we're going to go through risk management. We're going to get out of the accounting weeds, and we're going to talk more about some general business things. This is a topic we teach as part of a webinar. We're going to do a condensed version. It's part of a workshop series that Kathleen and I work on. We're going to do a condensed version of this that I think will be really eye-opening for people to think about risks they should focus on in managing their business. So you can sign up for those at this website address. We'll also put it in the chat at Greater Hartford. Go to score.org/Greater Hartford/local-workshops. You'll find those. Also want you to check out our YouTube channel. You can find recordings for this series and all of our other webinars. We've also got playlists that are organized by topic. You can subscribe to the YouTube channel to be notified of new videos. And as Kathleen mentioned at the top, if you're interested in mentoring, you can go to score.org and find a mentor. So with that, I see we've got some questions coming in. I'm going to stop the recording for now, and we can feel free to jump into Q&A.